Off we go. Good evening, everybody. Week 3 of Accounting and Finance. We're a third of the way through. Hard to believe. But want to make sure you're up to date on where we are in the class. We have posted assignment number 1 this past weekend. Those grades will be posted later on this week, and there also be with every assignment, I post a video explaining the solutions to that assignment. Some of you, I've begun the grading already. Some of you had no problems with the assignment. Some of you missed a couple of entries, and I'll just review all those after I post the grades later on this week. There'll be a special video that you can view to review any of the areas that maybe you were incorrect. And also, it'll help you as review to get up to speed for assignment number 2, which has been posted this week and due on Sunday, where we're doing adjusting entries, which is the topic for our week study. In this class, we're allocating 4 weeks to the financial accounting side of this course. And this is the third week of those 4. Next week, we will finish up the financial accounting study of our course, which will be looking at the closing entries and the closing of the books of the accounting cycle. Tonight, we are looking at adjusting entries. Adjusting entries are with the passage of time, the use of assets, the accrual of expenses and revenues, adjusting the accounts for these various activities after the regular business transactions have been made. And that's what assignment 1 was all about. You did regular journal entries, went through the cycle of doing journal entries, posting to the ledger, and doing a trial balance. Now in this next section, we're going to the next area of the accounting cycle, which is adjusting the journals, adjusting the accounts, preparing a new trial balance, and then preparing the financial statements of the company. Next week in Chapter 4, our final week of study of financial accounting, we'll talk about the closing of the books at the end of the accounting cycle and the final trial balance that has to be done once the books are closed, the post-closing trial balance. So assignment 1 was the journal entries, ledger, and trial balance. Assignment 2 will be the adjusting entries, trial balance, and financial statements. And assignment 3 will be the closing entries and the post-closing trial balance. And with those 3 works, we'll complete our financial accounting and then head on to managerial accounting, the second half of our class and study. So that's where we stand right now. In addition to that, just so everybody knows, here we go. With the posting of assignment 1 this week, we've completed 20% of our grade. With assignment 2 this week, we'll be up to 30% of our grade completed for this class. So as we move along, we're building towards the end of the course on August 3rd, which is the posting of your final examination work. Next week, we'll talk about in week 4 our case study paper, which we'll talk about next week, which is due the final full class week, July 27th. But for now, we've got 2 assignments in the books after the end of this week. What I urge you to do, and I'll talk more about this in my solution video later on this week, is to make sure you check your grades in your D2L Grade Center. All the grades are posted. If there's no grades posted for you, you should find out why Mr. Hassey has not posted a grade. So check your grades as we begin to start posting our assignment and our study work for this class. Our learning assignments for this week are pretty straightforward. We're talking about Chapter 3 and beginning the discussion of Chapter 4 this week. Chapter 4 mainly is next week. Tonight in class, we're reviewing 3 sets of exercises. Exercise in chapter 3, 6, 16, 17. Those are exercise to practice and understand adjusting journal entries and doing an adjusted trial balance and preparing the financial statements of a company. All exercises which you're doing somewhat in assignment 2 this week. Those are on pages 125 to 127. A solution exercise file is in week 3 that you can download and file along with me. And also the exercises from the textbook are also posted. I will post a second video this week. Anytime I give you an assignment and I have giving back grades, I will post a second video for this class to review the solutions of that assignment and go over anything that, as I grade the assignments, anything that I should spend particular amount of attention on as review for you students. That will be later on this week. And then naturally we have assignment 2 due on Sunday, and I will review that assignment a little bit later this evening. So let me go over a couple of key and broad issues of our study this week. Adjusting accounts. And we're concentrating mainly on these 5 areas of study that's highlighted in your text. Prepare adjusting entry for deferral of expenses. Now, what are deferral of expenses? Deferral expenses are what we've learned as prepaid expenses, prepaid insurance, prepaid rent. As those prepaid, which are current assets on our financial statements, as those prepaids are used with the passage of time, adjusting entries need to be made to make them expenses. And that's the deferral of expenses. You're postponing expenses until they are actually incurred. So an example of a deferral of expense adjusting entry is prepaids. Part 2, or number 2, adjusting entry for the deferral of revenues. Well, we've talked about that also in this class in prior weeks. That is unearned revenue. When you pay for a service in advance before the service was provided, I believe the example we use in our class is when you pay a retainer to a lawyer. The lawyer hasn't done any work yet. So that payment in advance is called unearned revenue, which is a liability account. You owe the service. Then as that service is provided, an adjusting entry has to be made, and that is called that's called deferred revenues, making the unearned liability a now revenue earned transaction. The third area is accrual expenses. Expenses that have been incurred but have yet to be recorded on your books. In other words, an accrual expenses would be payroll. Let's say you have a payroll on the last day of the month. Well, you make your payment to your employees, but at the same time, the next week you'll be paying the withholding taxes that you withheld from that payroll, but those expenses will not be paid until the following week. That accrued expenses has to go on the books as of the day of the payroll as an accrued liability, an accrued expense. And that goes into a tax expense, a tax payable account. So the accrual of expenses is to recognize expenses even though they remain due. The same thing, vice versa, is point number 4 of our study this week, accrual revenues. That is recording revenues or services that you have been provided, but remain unpaid to you, a receivable. So if you provide a service or interest is earned on an investment, and you record that with an adjusting entry as accrued revenues, a receivable is used. And then finally, the key point of this chapter is once all the adjusting entries are completed, all the accounts are adjusted, then you prepare another trial balance called the adjusted trial balance. And that adjusted trial balance is used to prepare the income statement, the statement of equity, and the balance sheet of a company. The key financial statements that tell you what happened. Those are the 5 key points of this week, chapter 3, that you need to review. We're practicing that in our review exercises this evening, and that's the subject of assignment number 2 for this week. Okay, so that's where we're at heading into this week's work.
Professor Hassey,
Yes, sir.
good question, because I saw something and it was bothering me because, and I just want to put a pin in there just so maybe you can touch on it when we get to that section. I was looking at the section on depreciation, and I had a question about um, how is the depreciation factored in when it's uh, uh, so- something that we purchased on credit? Because I know that we have notes payable in which we account for interest, but how is that tied to depreciation? And also, is there how do you link those contra accounts to the notes payable if there's interest being accrued as well? I know
Well,
I'm
notes, yeah,
but that's something that kind of stuck out to me in the reading, and I just want to make sure.
sure. Good question. It is a little bit confusing, but it's pretty simple to answer. Who am I speaking to?
This is Jason.
Jason. Okay, Jason. Um, Jason, what that means is there's 2 points in your question. Number one, the notes payable is how you financed that asset. How did you end up purchasing the equipment? Well, you borrowed money. Okay. That's a separate transaction in itself. You
Mhm.
purchased the equipment by borrowing money. So that's a separate transaction. And just to pull a transaction out of my head, it's debit equipment and credit notes payable. All right. Now, the next area, which is depreciation, is how do you account for the use over time of that equipment? You've
Right.
already funded it by the notes payable, so that's the only thing left to settle is you to pay off that note. But as in regards to the asset and the use of the asset called depreciation, that's a whole separate category and it has nothing to do with the notes payable. So when you depreciate that asset over time, you're creating an expense, depreciation expense, and you're recording what is called a negative asset account, a contra asset account. Accumulated depreciation is where you keep track on the asset side of the use or depreciation of that asset to that point in time. So they're 2 distinct transactions that have no relation to each other whatsoever.
So my question, just 2 last questions on this piece, and then I'll stop hogging the class. So for the depreciation amount, or the amount that we list for the purchase of that product, are we using the amount sans interest, or are we including what the accrued interest will be at the end of at the end of
No,
the okay,
interest has nothing to do with the value of the asset.
okay. So we're still
Interest is the
valuing
money
the asset.
owed on the asset. You're only depreciating the cost of the asset. Interest has nothing to do with it.
Okay. And then the other question I had about depreciation was it listed something about the expected value at the end of useful life. And my question around that was, how is that determined as far as that amount, as far as what the value of that equipment will be at the end of its useful life, as the book puts it?
Yep, a great question. Another name for the end of the useful life, Jason, would be scrap value or salvage value, the value of the asset determined after the years of beating the hell out of it. And that number is usually arrived at from 2 sources, Jason, in your company. For many businesses, and you might be familiar with this, the position of purchasing agent. A purchasing agent is a gentleman or a woman within a company that purchase all the assets and supplies and deals with the vendors of the organization. When the purchase agent is a professional that does the purchases of the assets for you, and usually that purchasing agent through the vendor of where you got that asset will determine the ending scrap or salvage value at the end of its useful life. It's not a specific number, it's just a guesstimate of what that value would be, and it's used in the depreciation calculations. So one source of that number is the purchasing agent working with the vendor of wherever you purchased that asset from. The second area that where you would get that scrap or salvage value would be your public accounting firm that's managing your accounts of your organizations. Many times, as you know, if you're a public corporation, you have to have an annual audit by a public accounting firm to review all your financial records and make sure the public knows that you're operating efficiently and effectively and legally. Many times companies involve the public accounting firm to come up with those estimates of salvage or scrap value for the assets. So they can come from two different sources within the organization, the purchasing agent, and outside the organization, your public accounting firm.
That's all I had a question on. I'm sorry, I didn't mean to hog up.
No, because that made me look good. It looked like it sounded like I actually knew what the hell I was talking about. So that made me look good. So thank you, Jason. I looked like someone I should be teaching this course. Ha. Okay, but those are great questions, and I appreciate those questions. And anything you all see now, sometimes some of you with your own jobs and your own outside of your MBA studies might be running into these terms or these procedures in your everyday life or in your business or in your transactions that you do. Please, if you are confused about what we talk about from the textbook to what happens in the real world, please ask those questions because then you can relate to them. I know this. Textbooks talk about specific generalities of accounting. And when you try to apply some of those to a real world accounting transactions, sometimes it can be a little confusing. So being able to relate real world to the textbook or our study work is important to understand the material. And questions like Jason just gave are great ways of showing that. So thank you, Jason. Okay. While we're on that, while I'm on a roll answering questions, does anybody have any other questions at this point of week 3 or what we've talked about up to this point in our class? Any other questions or concerns about our material? Good. Then let's move on. Thomas, why is your camera pointing at the ceiling? There you go. Okay, I just wanted to make sure you had a head. So I see your head, so everything's fine. No worries about that. All right, very good. Thank you, Thomas. Mr. Laura, we have no camera?
Hello, sir. Yes, I'll turn it on in a bit. Yes, sir.
All right, make sure your hair is combed.
Yes,
All right.
sir. Thank you.
All right, very good. Okay.
Yeah.
All right, so there we go. All right. So those are great questions. So those are the objectives of this chapter 3, and we're going to be looking at all of these points in our review questions. Deferral of expenses, deferral of revenues, accrued expenses, accrued revenues, and preparing the financial statements from the adjusted trial balance after you make these adjustments. These are all the key parts of chapter 3. Our review point tonight is these exercises, week 3 in-class exercises. If you have a text, you can go to the appropriate pages, 125, 126, 127, and follow along with me. But also I've posted these to our week 3 so you can download them or follow along with me. We're doing exercise 3-6, preparing these journal entries A through F for these companies. These are all examples of the journal entries we just talked about being discussed in chapter 3. Then we're doing this exercise on page 127, exercise 3-16. It's a two-parter. The first part, exercise 316, is you see all these account balances at the year end. I want you to take these account balances and put them into an adjusted trial balance. Okay. Once you have that adjusted trial balance complete, then you take that information in the second part, exercise 3-17, and we'll prepare the financial statements. From this adjusted trial balance, we'll prepare the income statement. From this adjusted trial balance, we'll prepare the statement of retained earnings. From this trial balance, we'll prepare the balance sheet. So this is the process of chapter 3, where in exercise 3-6, we're actually preparing journal entries. In exercises 3-16, the journal entries, adjusting journal entries have already been done. And here are the final account balances that we're going to put in an adjusted trial balance. And then from that trial balance, prepare the income statement and financial statements of the company for that period of time. So these two exercises highlight all the key points that you need from chapter 3 in this middle section of the accounting cycle. So they are located right here, especially if you don't have a textbook. It's good to follow along with that. And then here is the worksheet I'll be working on right here. I'll be filling this out tonight as we do the problem. So I'm not, this doesn't come up very well in this format here. So I'm going to get out of this and prepare it this way. And here they are right here. So this is the spreadsheet I'll fill out in class tonight. You can also download that spreadsheet and follow along with me. If not, you can also just take a look at this and follow along with me this evening. These are all examples of adjusting entries. We'll prepare the trial balance and then prepare the income statement, the retained earnings statement, and the balance sheet of this company. This is perfect examples of what you need to know from the middle section of the accounting cycle. All right. Let me go back here for a minute. The other information in this file folder will be benefit of you to maybe review. Some of you may have already done it prior to class tonight. Here is again, I showed this earlier. Here's the accounting cycle. And again, we're doing parts 4, 5, and 6 this evening. We did 1, 2, and 3 last week. We're doing 7, 8, and 9 next week to wrap this up. Here's a good video, again, just as a brush up that explains the accounting cycle. Another video, another interpretation, but it's the same material, the accounting cycle. And then here's a perfect example of the financial statements. Here's a trial balance of a company, the adjusted trial balance like we're doing tonight. And then what accounts end up in the balance sheet, in the income statement, and in the statement of retained earnings or equity. It shows you which accounts go where, which is a nice handy little cheat sheet of understanding how the financials are put together from the adjusted trial balance. This is a great overview. This is taken right out of your textbook, so you have that material as well. Okay. Well, as you can see now, you're beginning in week 3. Hopefully, most of you are getting into the flow of the course, how we do it, what's available in the weeks of week folders, and how we go about doing this. I'll get a better idea as I complete the grading of assignment 1, how we're picking this up. But again, the assignments mirror what we go over in class, in the lectures, what we provide in the weekly folders, and that should help you complete the assignments that you need to do. And then remember, all these assignments accumulate over our class and are highlighted again in our comprehensive final examination at the end of the course. Okay. Well, let's look at exercise 6 on page 125. And let's put this together. These are all examples of adjusting journal entries. Now remember, as I said earlier, Mr. Hassey, we have to do more entries? What the heck? First of all, we spent doing all these every transaction of every business event as journal entries. Then we have to put them into a trial balance, a general ledger, and then we put them into a trial balance. Isn't that enough? No, because certain events occur within a company and their transactions, they have to be adjusted. They have to be adjusted over time. The first transaction here on this exercise on page 125, letter A. Depreciation on the company's equipment for the year is computed as $18,000. Okay? This is what Jason was talking about earlier. All right, we've purchased some equipment. That equipment is hopefully creating products that we're going to sell and make some money. But at the same time, over time, that equipment is being beaten up. It's losing value. You guys all know this. If any of you own an automobile, when you buy a car for $50,000 and you drive it for 4 years and then you end up selling it or getting rid of it at the end of 4 years, is it going to be worth $50,000? I don't think so. It's probably going to be worth maybe about $2,000, depending on how much mileage you put on the car. That's a perfect example of depreciation. Depreciation is a way of accounting for the use of the asset over time. Now, we don't talk about it in this chapter, but later on in our study in managerial accounting, we're going to talk about how did they come up with this $18,000 of depreciation? How do you calculate that? Well, there's about 3 or 4 depreciation calculations that a company can select to depreciate their assets. But we don't have to worry about that now. All we have to do is worry about, okay, depreciation is $18,000 for this period of time. What is the journal entry for that transaction? Well, here's my journal entry page. I'm going to debit depreciation expense, $18,000, and I'm going to credit accumulated depreciation, $18,000. This is what you call a deferral expense. Why? We purchased something a month ago or last year. Now, with the past year, we've depreciated part of it. How much have we depreciated? Well, they gave it to us in this problem of $18,000. And notice it goes into 2 areas. I debit or charge an expense account called depreciation. This amount and this account goes on your income statement. It's an expense account. We're expensing the asset. On the other side, we're crediting an asset account called accumulated depreciation. Depreciation, when you buy the equipment, it's on your books as a debit. When you depreciate it, it goes on the books as a credit as you keep track of how much you're depreciating over time. So again, debit depreciation expense, credit accumulated depreciation. Depreciation expense goes on the income statement. Accumulated depreciation goes on the balance sheet of a company. Transaction B. Another example of a deferral of expense, prepaid. The prepaid insurance account had a $6,000 debit balance on December 31st before adjusting for the costs of any expired coverage. An analysis of the company's insurance policy showed that $1,100 of unexpired insurance coverage remains. And that's where I trick you in these problems. $6,000 debit balance in prepaid insurance means there's $6,000 of insurance that's been paid in advance but has yet to expire. Then they tell us on December 31st, an analysis of the insurance policy showed that $1,100 is still unexpired. So you now have to adjust the prepaid account to show a balance of not $6,000 but $1,100. In other words, $4,900 of insurance has expired. Here's the transaction. People do this for a living. Of course, they drink heavily at the same time, I might add. Ha. Okay. So we would debit the difference between $6,000 and $1,100. Debit insurance expense, $4,900, and credit, nice spelling, Mr. Hassey, credit prepaid insurance, $4,900.
Professor Hassey, are you doing this on the Excel sheet? Because all I can see is the example on in the portal.
Got it. Hang on. There you go. Thank you. See, when I go back and forth to files, sometimes the software gets a little bit slow or out of it. So I'll just read the transactions for you instead of going back to it. So again, it tells us in the problem, we start out with $6,000 of prepaid insurance, but now the balance is unexpired has gone down to $1,100, which means we've expensed the difference, $4,900, debit insurance expense, credit prepaid insurance. Okay, go to the head of the class, Mr. Hassey. Prepaid insurance, credit $4,900. Again, this is a deferral expense. We're now expensing the insurance with the use of it over time. Okay, the next transaction, transaction C. Here's a deferral of expense as well. The supplies account had a $700 debit balance at the beginning of the year. $3,480 of supplies were purchased during the year, which now brings the total to $4,180 of supplies available to use. The December physical count of the inventory of supplies showed that $300 of supplies are still available. What's the entry to adjust the supplies account to show the use of supplies for that period of time? So, arithmetic. We start out with $700 of supplies. We buy in an additional 3,480 supplies during the year. That gives us a $4,180 supplies balance. At the end of the year, they tell us that $300 of supplies are still available. That must mean we used $3,880 of supplies during the period of time. Debit supplies expense, $3,380, and credit supplies, $3,880. We're showing the use of expenses by taking an inventory. We purchased $3,480 of additional supplies during the year. We took a count at the end of the year, found that there was 300 supplies left. We must have used the difference, $3,880. Debit expense and adjusting the supplies asset account down to the inventory balance of $300. Clear as mud. Transaction D. 2/3 of the work related of $15,000 to $15,000 of cash received in advance was performed this period. 2/3 of the work related to $15,000 of cash received is now being considered earned. Well, what's 2/3 of 15,000? I would guess off the top of my head, debit unearned revenue, $10,000. And credit service revenue, $10,000. So $5,000 remain as unearned revenue that have yet to be provided. Why do I use service revenue? Well, if you look at the chart of accounts in the accounts that are listed in the top of this problem, it tells you that they use service revenue as a revenue account for this company. Right? 2/3 of 15,000 has now been earned. So we adjust the unearned account by that 2/3, debit 10,000, credit service revenue 10,000. That is called deferred revenue. Transaction E. Prepaid rent account had $6,800 debit balance on December 31st. Before the adjustment of the cost of expired rent, an analysis of the rental agreement showed that $5,800 of prepaid rent had expired. Debit rent expense, $5,800. Credit prepaid rent, $5,800. And this is where, especially as a graduate student, you should be able to figure this out. A transaction like this, let transaction E and transaction B, would confuse a lot of first-year accounting students. They're both adjustments to the prepaid account, but they're worded differently. In transaction B, they tell us that the ending balance of the policy should be $1,100 in the prepaid account. In transaction E, they tell us that $5,800 of the prepaid account has been expired. It's the same type of problem, but it's worded differently. And that's the challenge to the accounting students, especially the graduate accounting student, to make sure they can figure that out of how the wording explains the adjusting transaction. Those are two perfect examples of this. Transaction B, transaction E, both evolving around prepaids, but worded a little bit differently. Transaction F, wage expense of $3,200 has been incurred but not paid on December 31st. This is an example of a accrued expense that we talked about earlier. An expense that has been incurred but remains unpaid. All right. Wage expenses of $3,200 have been incurred, but remain unpaid. Debit wage expense, $3,200, and credit wage payable. We owe the money. It's been incurred, but remains unpaid. Deferred expense, deferred expense, deferred expense, deferred revenue, deferred expense, accrued expense. The only thing missing in this problem that is not shown is accrued revenue. All the rest of them are all provided in this example. Exercise 3-6, page 125. I will post these solutions after class this evening, so you have them as a template. Any questions on these examples of adjusting the accounts?
Yes,
Cool.
Professor.
Yeah. Yes.
For the E, what's the $6,800? What does it use for?
Nothing. Not in this one. Not in this one. Because the whole crux of this problem is telling you that $5,800 has expired. The $6,800 just tells you that the ending balance in this account after you do this transaction will be $1,000.
Okay.
That's why the difference between B and E, I was talking about it a minute ago, it's the same type of accounts, prepaids, but they're explained to you in different ways.
Okay, got it. Thank you.
So,
Good question. Thank you.
Hansi, if I can kind of circle back to the question. So say this wasn't December 31st, say that we were doing this at the 3-month mark or the 6-month mark of the year, we would just simply be looking at the expired rent up until that point in time. Or if we're doing it like month over month, the expired rent costs on a monthly basis, correct? So
Correct. If any of you work with companies in their accounting office, all these adjusting entries, especially for a lot of these transactions, are what is called automatic entries. In other words, at the end of a month, the computer system automatically generates adjusting entries for 1 month being gone by. Depreciation, supplies, prepaid, whatever, depends on the company naturally. But these transactions in the real world in accounting are automatically done by the accounting system. Here in our class, we're doing them manually so you can get to know why they work or how they do this. but you're right, exactly right. These, if it's a month, you naturally, if you're doing this monthly, which we all do because every company does accounting reports for the month end, these would be done automatically at the end of every month, and then they would accumulate over the year as you're adjusting the accounts throughout the 12-month fiscal year.
Right, because I'm assuming, uh, for some people, this is a way for them to kind of manage against their budget that they have on a either quarterly or annual basis or whatever. They're, just kind of track to see how they're looking over the course of the year. Just trying to do it a practical explanation, or looking at it from practical point of view. Basically, looking at it as if I have a certain amount allotted to me for my budget for as a department manager or whatnot, this is how I will look at my month over month expenses, making sure everything lines up and making sure there's nothing out of whack, correct? Or
Exactly. But if I was a department manager, like you were just talking about, you should know that the controller's office or the accounting office or the treasurer's office or the CFO office of the company, they're responsible to maintain these transactions and these accounts throughout the year. So when the department manager gets their monthly report, they know, hopefully, if these are all done correctly, that the accounting department has done their job correctly and they're getting an accurate assessment, an accurate statement of their accounts through that period of time. Because the department managers, they don't maintain these accounts. They don't do the journal entries. That comes naturally from the accounting office of the organization, and they uptake these methods or these accounts every month, and then the departments can actually see these adjustments hitting their appropriate budgets. That's correct.
right, all right, thank you. I'm sorry to keep barging
You say you're sorry again one more time, I'm gonna get mad at you. You don't have to say that. This is part of the class. You're asking great questions, so don't need to say sorry.
in.
I should say I'm sorry when I spell insurance incorrectly, but you should never say you're sorry for your questions. They're excellent questions. As a matter of fact, I would be severely upset, especially teaching a bunch of MBA students, if they don't ask questions and relate some of these questions to their own experiences and applications in their own careers and where they're at in their careers as department managers or entrepreneurs. Because if we had all silence here, I was going, well, what are these students doing for real world stuff? Don't they run into this stuff? That's why you're taking this at the MBA level to see how this filters down to the real world and how these numbers show up in your department budgets and how you manage your departments. This is an exercise that provides that information, how these occur. So Jason, you're asking great questions. So
I'm just relating it because I'm in project management, so I have to kind of deal with budgets and costs and expenses on a regular basis. So, I mean, I never dove into this kind of detail about certain things, but I can kind of tie the two together, I guess you could say.
excellent. You're a great advertisement for why you take this class. So thank you. Okay. Now let's go down a little further and let me get out of this just for a minute. Alexandra, how's your cat doing?
She's doing well. She's sleeping right now.
So she trashed your computer and you're letting her sleep.
Yep. Oh, no, so unfortunate.
You're a good mom. That's good. Okay, let's bring this up. Okay, now we're going to the second part of our exercises this weekend. The first part, which we just did, we gave examples of adjusting entries. Okay, now let's go on to the next page, on page 127, and look at exercise 3-16. In this exercise, we're doing two things. We're creating an adjusting trial balance, taking the information given to us and knowing that our knowledge of what these account balances should be, we're preparing an adjusted trial balance. All right. From that, then we're going to take that adjusted trial balance and prepare in exercise 317 the financial statement. So this is what I would like all of you to do in the next 10 to 15 minutes. If you don't want to do it, you don't have to do it, but this is good practice. You have that blank worksheet that I provided. What I would like you to do is to take this information here, notes payable 11,000. Is that $11,000 debit or $11,000 credit? Prepaid insurance, is that $2,500 debit or credit, and so on. You are to determine what type of balances these accounts have, and then I want you to list them in that worksheet. Hang on. Again, you don't have to do this because I'm going to be doing this as well, but I'm going to allocate a couple of minutes where you guys do this. You've been too lazy thus far in class. Now I'm going to put you to work. And so now we're going to bring up this spreadsheet. And here's a blank trial balance. Notice I have it color coded for our next work in this exercise, where the yellow accounts are balance sheet accounts and the green accounts are income statement accounts. That's kind of a helpful hint there. But now what I want you to do is take the listing of all those accounts and list them here. And let's see if they total equally. For example, I just talked about notes payable. Well, notes payable is a credit balance. All right, I put it there. What's next on the list? Prepaid insurance, $2,500. Okay, that would go here. And so on. What I would like you to do is go through the rest of those accounts, put it in the proper debit and credit balance side, and let's see if we can come up with a balance adjusted trial balance. All right. If you need time, go out and get a sip of wine. If you need time, have a glass of water. But what I'd like you to do in the next 10-15 minutes is finish this trial balance from those accounts that are listed on page 127, exercise 316. And while you're doing that, I'll do it at my end with the screen blank so you don't get to see it. And then we'll come back in about 10-15 minutes and take a look at what this should look like from exercise 316. Ready, set, go. See, now Melissa's not going to, she's going to blow it off. She's not going to do this, but I get to see her with her camera on. She doesn't look like she's going to be doing. Then she's going to feel guilty. Why am I not doing this problem? Mr. Hesse can see me.
Excuse me, I'm doing it, okay?
Okay, very good. So I'll shut up. I'll come back at 7 o'clock and we'll take a look at this problem. That's a better looking picture of me anyways. Okay, here we go. As you can see, the adjusted trial balances by taking those balances on page 127 is $73,600 debits, $73,600 credits. Hope you all got that. And the key part of that is now that you should be familiar with what type of account balances all these accounts. Now, one of the areas where people can get confused is accumulated depreciation. That should always have a credit balance. You purchased a building for $40,000, and as of December 31st of this year, you've depreciated $15,000 of that 40,000 has been depreciated. So that's the credit side of that asset account. Okay. Notice all the liability accounts have credit balances. Notice all the expense accounts have debit balances. So these are typical things that we should talk about or should know. So once I have that adjusted trial balance, now I can complete the income statement, the retained earnings statement, and the balance sheet. All these three are linked to each other from these balances in our trial balance. Okay? So let's do the income statement. The first thing you should realize when you're doing financial statement preparation, I know this sounds kind of geeky, but we have to be aware of that, is that you have to have the proper heading of that financial statement. You got to tell the user what's the name of this company? What is this financial statement about? And what is the period that this financial statement covers? Okay? That should be in every financial statement. If you just have a blank heading on an assignment or an examination, you'll get the whole thing wrong because it doesn't tell the readers or the users of this data what period or what this is all about. So one of the first key things to remember is complete the proper heading to that financial statement. The income statement and the retained earnings statements are for a period of time. The balance sheet is as a given date. One more time. The income statement is for, in this case, 1 year ended December 31st. The retained earnings statement is 1 year ended December 31st. The balance sheet is on the date December 31st, not for the period of time, on that date. So make sure as accounting students, you have the proper headings to those financial statements. So now let's complete these and see how they all link together and what do they tell the users of these statements for this Stark company. First of all, the revenues were $20,000. That was the revenues taken from the adjusted. Let me make sure I get all the proper little things here. There we go. Okay. Revenues were $20,000. That's the revenue balance on your trial balance. So that means the total revenues were $20,000. Cool. Expenses. All right. We had a lot of expenses. We had wage expense. $7,500. We had interest expense. $500. We had insurance expense. $1,800. Looks like we're going to need some more lines, like 3. So let's add these here. All right, here we go. We had supplies expense. $200. We had utilities expense. $1,300. Again, these are all taken from the adjusted trial balance. And we had depreciation expense on the building. $2,000. Total all those up. $13,300 total expenses. Subtract expenses from revenue. We get a net income of $6,700. That's our income statement for the Stark Company. Notice I don't see any asset accounts. There's no cash, there's no receivable, there's no accumulated depreciation, there's no payables, there's no stock, no dividends. All we see here is net revenues and expenses. The company for the year ended December 31st made a $6,700 profit. Bellissima. Very good. Now we'll take this information and complete the retained earnings statement for this period of time. They tell us in the problem in exercise 3.17 that the retained earnings account balance was $14,800 on December 31st of the prior year. So that means at the beginning of this year, it was $14,800. Beginning balance to the year. There it is right there. All right, they gave us that in the problem. Well, we just found out that our net income was $6,700 from the income statement, right? There it is right there. And then from the trial balance, we saw that our dividends were $3,000, less dividends of $3,000, which means a net gain of $3,700 for the period of time. So our retained earnings balance at the end of December 31st is the beginning balance plus the gain, profits less dividends, $18,500 ending retained earnings balance. Again, the $14,008 is given in the problem as the balance at the end of the previous year. So this is a balance sheet account, so it transfers in to the next year. And you notice on the trial balance, we saw that $14,000, $800 right there. It was part of the trial balance. That's our balance at the beginning of the year. Then we had the net income of the company. We're told that they paid out $3,000 in dividends of the profits to the ownership. The net effect, $18,500. Now this $18,500 will now go over to the balance sheet, and we'll put that in here in just a minute. Here's the balance sheet of the company, which is a statement of assets, liabilities, and equity on December 31, on that day. No period of time, on that day. Income statement for the year ended, profit $6,700. Retained earnings statement, year ended December 31st, $18,500. And now we'll do the balance sheet and we'll list the assets. Cash, $10,000. Accounts receivable, $4,000. Supplies, we're listing all the assets from the adjusted trial balance, $800. Prepaid insurance, $2,500. Buildings, $40,000. less accumulated depreciation minus $15,000. Okay. So notice, because the accumulated depreciation was a net credit balance asset, you list that as a minus on the balance sheet. And I don't like these bold numbers, so I'm going to get rid of this here. Let's make this regular. There we go. Okay. Any other assets? Nope. That's all the assets. So the total assets are $42,300. Cool. Liabilities. Accounts payable. $1,500. Again, let's get rid of these bolds here. Cool. Interest payable. $100. Wage payable. Wages payable. See, what we're doing is we're taking all the accounts and putting them in the proper categories in these financial statements that tell us something about the company, whether they're successful or not. Unearned revenue is a liability. $800. Notes payable is another liability. $11,000. All right. And that's the end of our liabilities. Total liabilities. $13,800. Equity. Common stock. $10,000. Retained earnings. This comes from our retained earnings statement right there. $18,500. Now the moment of truth. Total equity. $28,500. Total liabilities and equity. 13,800 plus 28,500. And golly Gomer, $42,300. Our assets equals our liabilities plus equity. Our company now has completed the financial representation for the Stark Company for the year ended December 31st. We have shown that they have a profit, revenue less expenses. We have shown what their equity position of their retained earnings is, how much of the profits to date they have retained, net income less dividends. And that equity section is part of the common stock of the equity section of the company, and their assets and the debts and equity that have financed those assets equal. Now, it doesn't mean that this company is excellently run, but it does mean they're accounted for excellently. They're in balance. Yeah, they made a profit. Maybe some people say, that's all the profit you made. That's not too hot. But that's why we have budgets. This will lead into the managerial accounting section later on in our class. You have a budget. Okay, this year we planned on making $50,000. What? We only made $6,700? Why were we so under budget? Well, that's part of management. As Jason indicated earlier, he's a department manager. He's given a budget. If he exceeds or goes less than his budget, he's a hero or he's in trouble. That's why we have budgets to compare to these financial results. But that's what we'll talk about when we get to the managerial side. At this point in financial accounting, we're just accounting for the events of the business for the period ended December 31st. Any questions on adjusting entries and financial statement preparation off the trial balance of the company? Cool.
Can you leave it on this tab? I messed up on one or two entries, and I just wanted to make sure I got it right.
Where do you want me to leave it?
On this page right here.
Okay. Let me know when you're okay, Jason, or you need me to explain anything.
I'm just lining it up. I'm trying to figure out where I'm off by like a couple $100. So I'm sorry about. I mean, it can wait till break. I don't want to hold up the class.
Well, we're not going to take a break tonight. We already took our break when we did the 10 minutes to do this.
Oh, okay.
We're going to go straight through.
Okay. Can you give me like 1 more minute? 1 more minute. All right. All good.
Excellent. Okay. So what have we done? Well, we first of all practice what typical adjusting entries look like. Secondly, we've taken now all the entries up to this point in time, beginning or business transaction or general journal entries and adjusting entries, and have produced an adjusted trial balance of the company. Then we've taken that adjusted trial balance and now told the people who want to know what's going on in our business, these are the published financial statements that we show the world. We do not show them the adjusted trial balance. A lot of people look at this and go, what the hell does this mean? Did they make $73,600 in profit? No. Do they own $73,600 in assets? No. Do they owe $73,600 in liabilities? No. What it tells us is that the accounts in the ledger are balanced. Then we take these accounts and put them in a format that tells people, tells investors, tells managers, revenues minus expenses. Hooray! We made a profit. This is the amount of retained earnings the company has retained since it began, 18.5. And here's a statement of assets, things that they own, liabilities, money or services that they owe, and the equity position of the ownership. So the owners invested $10,000 in this business. Now the owners own $18,500 more of the business because they get the profits. And so the ownership has had a nice return on their invested capital thus far in this business. And it totals $42,300. So these financial statements now tell us what happened. Now our job is Chapter 4, which we'll discuss next week, and I'm going to show you this in relationship to this problem here tonight. What do we do next? Well, we've recorded all the events, we've adjusted the accounts, we've prepared our financial statements. So what is next? Closing entries. Now we have to close the books. Close the books. In other words, close out the temporary accounts so we can begin the next accounting period, December 31 of 2006 or whatever, or 2026, so we can see what our business was in the next year. Now, what are temporary accounts? Temporary accounts are income statement accounts. Those are temporary accounts. That means they have to be closed at the end of the year. What is also a temporary account? Dividends is a temporary account. All the other accounts, assets, liabilities, and the equity of the company all carry forward their balances into the next business year. But when we close the books, we close out these temporary accounts. And that's what chapter 4 is about next week. How you close these accounts. And here's how you close them. I'm going to steal this here. And put this here. I'm going to post all this when we're done. So closing journal entries, all dated December 31. And what we do is now we go through, as I just said, we close these temporary accounts. How do you close an account? Well, if a revenue account has a credit balance of $20,000, to close revenue, you debit it. $20,000. That account now is closed. Where do you put the offsetting credit? It goes into another temporary account that you close for, that you put in for closing entry. It's called income summary. Income summary is credited $20,000. I have now closed revenue. That account now is zero balance, and now I can see what my revenue is going to be in 2026. At the same time, I'm going to close my expense accounts. Wage expense has a debit balance. To close that, I must credit it, $7,500. Interest expense has a debit balance of $500. I credit it by crediting interest expense, $500. Insurance expense has a debit balance in their account of $1,800. I credit it $1,800. That account now is closed. Supplies expense has a debit balance of $200. I credit it $200 to close that account. Utilities expense has a debit balance of $1,300. I close it by crediting it. And depreciation expense on the building has a debit balance of $2,000. I now credit it $2,000. So now I have closed out all the expense accounts, and we can see in 2026 what my expenses will be for that particular year. The offsetting debit of this goes to income summary. $13,300 debit. So now I have closed all the income statement accounts through the income summary account. My last entry to close this out is to now zero out the income summary account. The income summary account has $20,000 of revenue in it and $13,300 of expenses. That means it has a credit balance of $6,700, which just so happens to be our net income. Income summary. So now we debit income summary, that difference or net income of $6,700. And where does the credit go? Retained earnings. The balance sheet account is now credited $6,700. So now this is the closing entries for the year end. All the revenue and expense accounts are now been closed to income summary, and an income summary account is closed to retained earnings. And then finally, the last temporary account is dividends, $3,000 debit balance. So we close that to retained earnings as well, debit $3,000 retained earnings and credit dividends, 3,000. So now we've closed the dividend account and we know what dividends we're going to pay in the next year, 2026. And so now all the temporary accounts have now been closed to retained earnings. And what's our retained earnings account balance going to be at the end of all this? Just like it says right here, $18,500. This is an example of what chapter 4 is about, closing the books. Notice I did no journal entries that involve any of these accounts here. I've only closed the temporary accounts here, and here's that closing entry example. And then from this, I do this. I prepare now a post-closing trial balance. Since all of these accounts have been zeroed and closed, they are now all have no balances. All right. At the same time, retained earnings has now been increased, credit 6,700 and debited 3,000 to $18,500. Oop. And there we go. We've now posted the post-closing trial balance of $57,300, which lists all the accounts that are going forward into the next fiscal year. And notice the dividends, revenue, and expense accounts are all empty. So in your companies, when somebody says, oh, it's year end, or it's month end, or it's quarterly end, we have to close the books. This is exactly what those companies do. They go to their final adjusted trial balance, and then they close out all the temporary accounts, debiting revenue, crediting expenses, crediting dividends, all through the income summary, and it all ends up in retained earnings. And then the final thing of closing the books for the end of the fiscal year or the month or whatever is a post-closing trial balance. And now these balances go forward into the next year. And in that next year, we see what our dividends will be. Are we having any additional, what our revenues are going to be in the next year, and so on. But these accounts all go forward because they're ongoing accounts. They're balance sheet accounts. You can't zero out cash and say, oh, let's zero out cash on December 31st. Well, that's it. That's incorrect because you still have $10,000 in your checking account. You can't zero that out. The same thing with receivables and all of them. Those are all carried forward in the next year. And where all this activity ends up is right here in retained earnings to take it in to the next fiscal year. That's what chapter 4 is all about. And we'll be looking at a couple of problems and exercises next week that will practice this. And that's what assignment 3 is going to be all about next week. This week, assignment 2 is concerning this process here. Okay? Anybody have any questions on what we just did? I'm going to post this file back to week 3 at the close of class this evening. So let's now take a look at assignment 2, your work for this week. I've taken assignment 2, not that I'm lazy, but I took assignment 2 because I thought this is an excellent problem to show the events of chapter 3 that we talked about tonight. This is a problem taken right out of your textbook. Problem 3-3A in your textbook. This is the work you're going to do for this week, due on Sunday. Here it is. Wells Technical Institute provides training to individuals who pay tuition directly to the school. Wells Technical Institute offers training to groups in offsite locations, blah, blah, blah. Its unadjusted trial balance as of December 31st follows. And here it is right here. Here's their unadjusted trial balance. They haven't made the journal entries yet. You haven't made the journal entries yet. This is their unadjusted trial balance. Now, your job in this problem is now to do these adjusting entries A through H. You're going to do these adjusting entries, and then you're going to make the adjustments to the account balances and come up with an adjusted trial balance. And once you do that, then you're going to prepare the income statement, the statement of retained earnings, and the balance sheet for December 31st with a retained earnings beginning balance of $80,000. Just like we just did. You're going to record these entries, complete a new adjusted trial balance, and then prepare the financial statements. That's your assignment for this week. I have given you an Excel worksheet to do this problem. Here it is right here. First of all, here's the general ledger. Okay. So what you need to do, you'll need to fill this out with the unadjusted balances. Then you do the journal entries A through H here. Go back and post them to the ledger. And then prepare an adjusted trial balance for the company. And when you have that adjusted trial balance done, I give you all the accounts. Then do an income statement, a retained earnings statement, and a balance sheet for the company. And what a great guy I am. I've given you all the accounts in their proper sections. You just got to come up with the numbers to make sure everything balances. So again, the transactions are to take a look at the events in the textbook and in the material provided you, then go to this worksheet, fill in all the necessary numbers. Save it and post this file to your D2L for the assignment 2 completed. That's your work for this week. Based on the material we covered this evening, this process to do this should take you about an hour and a half. Any questions on assignment 2? So if I go to my D2L right now, here's our course D2L. If I go to assignments, you will now see assignment 2, adjusting the accounting. I give you the PDF of those problems taken out of the chapter, or you can use your text chapter textbook as well. And here's the worksheet that you need to download and prepare your work on. Then when you're done, you upload that spreadsheet with your name on it and upload it to this folder, submit the file, upload it, excuse me, and then submit it, and we're off and going. That is assignment 2 for this week. Last week we did introduction to accounting. This week, assignment 2, adjusting accounting. Next week we'll do assignment 3, closing the accounting. And that will complete our financial accounting section for this course after week 4, or we're halfway through our course. That's the work I want you to do this week. I will post a video at the end of the week going over the solutions to assignment 4, in case anybody's still a little bit shaky with debits and credits and accounting definitions. And then we'll review that with the grades posted later on this week. And that might make you feel a little bit better as you head into doing your work for assignment 2. I'm recording this session tonight. Anybody have any concerns? You can always go back and review this video, or you can go to week 3 file folder, and I will post the solutions to this exercises that we've worked tonight. And there's again backup information in case you get a little fuzzy. I find students find that this is a nice little thing taken from the textbook showing what accounts and the adjusted trial balance go to the particular financial statements. That's a nice cheat sheet to even print out and have that by your side. So as you do financial statements, you make sure you put the proper accounts in the proper statements. And it's always nice to end a class seeing Mr. Hassey's lovely smiling face saying, you've done another great job. You guys are almost done with the accounting work in this class and you're all doing very well, but we'll give it an even better idea once I look at your work this week. Now, let me tell you this, and I'm not telling you this to scare you. I'm not telling this to freak anybody out, but in the past, teaching this course to MBA students, naturally, some MBA students haven't had accounting much in their past, or it's been a while. Sometimes these first few assignments tend to be a little bit tricky and not as good performing. If I think this class has not done as well as I wanted you to do on assignment 1 and 2, I'm going to slow down the class and make sure we maybe spend an extra week on financial accounting to make sure everybody can get this correctly. Here's why. The most important thing you need as an MBA student is not to do journal entries, but to understand why journal entries happen and what they produce to tell you, the manager, about your business. And if you don't understand that or can't get that, I'll slow the class down to make sure we all get where I think you should be in knowing this material. Fair enough? As of now, I don't think that's happening, but I have done it in prior classes. It doesn't say anything bad about the class. It doesn't, everybody still is going to do well. It's just I'm going to slow it down, making sure everybody understands what we need to know. So as you, as an MBA student, when you go on to other classes, strategic classes, management classes, finance classes, that you have a good basis of understanding accounting. So that'll help you learning that other material as you complete your MBA degree. That's the purpose of this class. With that being said, look for my video later on this week talking about assignment 1. If you have any questions, ask me during the course of the week about assignment 2, and I'll look forward to your work this weekend so I can see where we are through the 2/3 of the accounting cycle. Anything else I need? Anybody, anything else you need from me this evening?
Just a question. When would this Zoom be posted?
What do you mean by this? This work we did tonight?
Recording, yeah. When would the recording be posted?
Probably in the next 5 minutes as soon as we sign off.
All right, cool. Thank you.
Okay. Anything else? You're done good. This is a lot of material, but I think I'm going at the pace that I think you guys can handle. And then we'll just see in the results of our work this week how we did and where we go from here. So thank you very much. You've been very attentive. Good luck with this week. And I stand by to help you any way you can if you have any issues. Have a great rest of the week, everybody. And I'll post this video later on this evening as soon as it's processed, but I'll post the solutions to our work immediately as soon as we're done here. Have a great night. Let's go watch the Dodgers lose to Colorado, and I'll see you all next Tuesday. Adios.
Thank you, Professor.
You, sir. Have a good one.
Thank you.
Thank you.
Okay, bye-bye.
Bye.
Thank you, Professor.
Thank you.